Hello, everyone. As Nigel said, I have been the lead Cobalt analyst at CRU almost for the last 2 years, and I recently became responsible for our molybdenum research as well. My team also covers the nickel, stainless steel, and ferrochrome markets. And it happens that nickel is not within my regular research areas, as I mainly cover it in order to assess cobalt production as a byproduct of nickel. Therefore, the nickel section of this paper comes from the January issue of our Nickel Market Outlook. Here you can see the structure of the paper, which consists of 2 parts, the first on nickel and the second on cobalt. Starting with nickel, we will talk about contemporary trends, prices, supply and demand, followed by the market balance and price forecast. So what are the main themes in the market? Prices are under pressure because of oversupply. Regarding consumption, we have revised up our Chinese stainless steel production numbers to account for higher output reported by the China Stainless Steel Council. On the production side, mine output exhibited strong growth in 2012, driven by Australia, Indonesia, and the Philippines. Having said that, Chinese nickel pig iron production is understood to be robust on the back of new capacity. Indeed, there is considerable capacity coming on stream in the near term using RKEF technology. We anticipate that the nickel market will remain in surplus, putting downward pressure on prices. This graph shows LME nickel prices and open interest. You can see the downward price trend since early 2011, which is driven by the fundamentals. Volatility around the trend is caused by factors not immediately related to demand and supply. For instance, at the beginning of 2012, the rally was accompanied by a contraction in open interest, which led us to believe that it was driven by fund short covering activity, followed by a correction to the long-term trend. Similarly, the rally in September 2012 was driven by encouraging macroeconomic developments that followed a period of elevated uncertainty. We believe that there is limited room for further downward movement. Indeed, prices have lately been hovering within a narrow range. As the black dotted line illustrates, in the last 6 months, prices averaged $17,000 per ton, and any fluctuation was around that level. Our view is that this pattern will continue in the current year. Here we are showing the annual change in global mine production in 2012. At the left and the right, you can see global mine production in 2011 and 2012. At the center, we have included the annual regional change in 2012. Mine output growth in Asia was attributed to Indonesia and the Philippines. Indonesian mine production advanced by an estimated 14% last year. Exports from Indonesia advanced by 25% in the 3 quarters of 2012, with China having been the major destination. There is still confusion regarding the timing of a ban on nickel ore exports from 2014. The purpose of this ban is to encourage the development of downstream sectors, and a number of companies have put forward plans to build smelting facilities. Our view is that a complete ban is unlikely. However, what we see as a more likely scenario is that a further rise in cost of export ore may take place. Mine production in the Philippines benefited from the imposition of a tax on ore exports from Indonesia. In addition to this, nickel production in the Philippines was boosted by the approval of operations in domestic mines. Mine production growth was robust in Australasia too, primarily attributed to the Ravensthorpe facility. Moving on to this slide, we project that global mine output growth in the current year will slow down. This partly reflects our assumption that the NiCoMo plant in Cuba, the Southern Urals nickel plant in Russia, and the Loma de Nickel plant in Venezuela will remain closed throughout the year. Also, the Onca Puma facility is anticipated to contribute to a limited degree. Furthermore, a number of closures that have been announced will add to the slowdown. Mine production growth is expected to accelerate in 2014 as operations will start, restart, or ramp up. Growth is predicted to gradually slow down by the end of the forecast period. Here we are looking at refined production, and this chart illustrates growth by country in 2012. Output in major producing countries advanced last year. Indeed, refined production in Australia, Japan, and Brazil witnessed a considerable increase, which was largely due to operations returning to normal production after challenges in 2011. The largest contribution was from China due to higher NPI production. The commissioning of RKEF capacity and strong imports of nickel ore last year has led us to revise up our early estimates of NPI output. This chart shows a long-term picture of total refined production annual growth. We forecast that global refined production growth will decelerate in the current year. Nevertheless, the increase in production will be supported by commissioning of new capacity. One of the key projects is Xstratas Koniambo in New Caledonia, while another closely watched operation is Vales VNC. China is projected to continue seeing strong refined production growth due to an expanding NPI sector. A potential downside risk is the planned Indonesian ore export ban, but as discussed earlier, we are of the view that the most likely outcome will be an increase in the cost of exports. We are turning to consumption, and this slide is looking at stainless output. The bars illustrate stainless production, while the two lines primary nickel and nickel scrap used in stainless steel. In the last quarter of 2012, primary nickel consumption in stainless steel exhibited a recovery. The growth is attributed first to an increase in stainless output and second to a fall in the contribution of scrap. In particular, primary nickel content was supported by higher production levels of high nickel content stainless steel. The growth trend in 2012 was backed by strong stainless production in China. The situation was different in Europe and the US, as high utilization of scrap continues to affect consumption of primary nickel. Here we are looking at primary nickel consumption in non-stainless applications. All sectors exhibited decent growth in 2012. However, non-ferrous alloys saw the fastest growth. On the other hand, with the exemption of China, demand from alloy steels has been weak. Primary nickel consumption in batteries has traditionally been an Asian business, with 2/3 of demand coming from China. This is a challenging sector to estimate and forecast, mainly because of rapid developments in technology. What we are presenting here is the difference between primary consumption in China and the rest of the world. Total primary nickel consumption in 2012 was supported by advances in stainless and non-stainless sectors. On the stainless side, it was China that led the way last year. Elsewhere, nickel consumption was negatively impacted by muted demand, low prices, production cuts, and affordable stainless steel. On the non-stainless side, demand for nickel expanded faster in the rest of the world compared to China due to strong performance in non-ferrous alloys. This forward-looking chart covers total primary nickel consumption. Having estimated decelerating growth in 2012, CRU projects that growth will pick up in the current year. This partly reflects higher consumption in the USA. Indeed, primary nickel used in stainless is expected to recover from a drop seen last year, while a healthy non-stainless sector is also anticipated to support demand. In addition, we are of the view that consumption in Japan will benefit from government policies and return to growth after 2 consecutive years of decline. However, we believe that the main demand driver until the end of the forecast period will continue to be China. This chart presents the market balance and price forecast. After a surplus of about 46,000 tons in 2012, we project that the market will remain in surplus of a similar magnitude this year. Last year, LME nickel prices averaged $17,500 per ton, and our expectation for the current year will be similar. Of course, a degree of volatility is expected due to the influence of non-fundamental factors. From a fundamentals point of view, we project that prices will pick up in the second quarter and then come off in the third. Prices are expected to trend upwards in the last quarter and continue moving on a positive trend until the end of the forecast period, as the market is expected to become tighter. We will now summarize the nickel section and also refer to some major risks. Looking at prices, oversupply puts downward pressure while macroeconomic developments cause volatility. Production increases in the future are expected to be supported by commissioning of new NPI capacity. There is considerable NPI capacity coming online for which producers are building stocks of raw materials. On the consumption side, we stress that the stainless sector, the growth in China requirements will boost demand. Non-ferrous alloys and batteries are anticipated to provide impetus to non-stainless demand. However, the element of risk is still there, as macroeconomic concerns remain despite some brightening prospects in the last few months. If these risks materialize, the demand outlook will be negatively impacted, and so will prices. Finally, production delays could also lead to higher deficits, and that will support prices. Regarding where we are in the presentation, we have completed the first part which was on nickel, and now we are turning to our second part, which focuses on cobalt. We will first discuss the major trends in the cobalt market. Cobalt prices are low by historical standards and feature low volatility. Another major trend is consolidation. Towards the end of 2012, we took a closer look at the Chinese refining sector and found out that considerable consolidation activity has taken place. Moving on, a trend worth emphasizing is the structural change in raw materials. With more than half of primary refined cobalt currently produced in the form of chemicals, intermediates are the raw material of choice. We should also refer to the increasing contribution of batteries to cobalt consumption. This chart shows monthly prices in the last 2 years. Prices have been hovering around the negative trend, which we attribute to oversupply. We have lately seen periods of low volatility, which is partly a result of a quiet market. However, this is also a sign that the market has stocks that act as a buffer to changes in spot demand. Another point is the premium, which we define as the difference between low and high-grade prices. If you look at the two price trajectories, the premium has narrowed significantly. We believe that availability of cobalt metal and substitutability between the two grades are the reasons behind this trend. Turning to production, this table refers to mine operations using 2011 data. The African Copper Belt delivered 60% of cobalt units, and these were mines where the primary metal was copper. Another group of mine operations were in Russia, Cuba, Australia, and Canada. Lateritic deposits in the Pacific, found in Indonesia, New Caledonia, and the Philippines, made the bulk of the remainder. In recent years, production growth was mainly attributed to new copper mine capacity, especially in the DRC, and in particular, cobalt hydroxide and cobalt carbonate operations. Looking ahead, with low prices and a weak medium-term price outlook, the prospects for new cobalt projects are currently looking challenging. We believe it is insightful to also look at the growth of intermediates that are used as feed in the production of chemicals and represent the raw material of choice due to operational and logistical efficiency. Ambitious copper-cobalt projects in the DRC and nickel-cobalt high-pressure acid leach operations in the Pacific are central to this growth in this segment. Interestingly, this development has changed the structure of the cobalt industry, which used to be predominantly a metallurgical one. CRU believes that this sector will continue to supply raw materials to China and Finland in order to produce specialty products. What you see here is total refined production. we distinguish between refined metal, refined chemicals, and secondary supply, and you can tell how strongly total production has grown since 2009. So far, production of chemicals has mostly been responsible for this growth. A major contributor to this was the expansion of intermediates capacity. Looking ahead and taking a relatively conservative approach, we project that production will continue growing, attributed to ramp up at existing operations. Unsurprisingly, the most challenging factor is China. Our view is that Chinese production expanded last year, and that took global supply to 82,500 tons. Talking about China, this is a convenient point to talk about the accumulation of raw materials. We believe that in 2011, stocks amounted to about 15,000 tons of cobalt contained. In 2012, Chinese imported feed contracted by 15%, and that resulted in a steep reduction in stocks, which we estimate at about 8,000 to 9,000 tons. It would be interesting to predict the future trend, as at this point the stocks to consumption ratio stands at about 3 months, and our view is that there will be no intention to destock further. Our expectation is that this year China will not see a decline in imports of raw materials. We are turning to demand, and this slide shows consumption by region, with the pie chart providing regional shares in 2012. CRU estimates that China accounts for 36% of consumption. What is important in China is consumption by chemical sectors. In the case of metallurgical sectors, the USA and Western Europe, as well as Japan, maintain a big share due to established industries such as aerospace, advanced engineering, and special steels. The two boxes on the right provide the share development in the USA and China. The message is the fact that China has captured the largest part of the global growth. This relates to the transformation of the cobalt industry from a mainly metallurgical one to a growing chemical. Here we are looking at demand between 2008 and 2016. Downstream sectors exhibit healthy growth rates despite economic uncertainty. This doesn't imply that the market is not subject to downside risks, as we have revised down our forecast significantly since last year. But on a positive note, we revised up the intensity of use in rechargeable batteries. We estimate that global consumption reached 81,000 tons last year, which is double the volume of 2001. Currently, a structural change in the cobalt consumption is the gradual switch from standard mobile phones to smartphones, which have advanced battery requirements. In this slide, we are briefly referring to the risks that have been expressed after overheating incidents at Boeing 787 batteries. Lithium cobalt oxide batteries were chosen mainly because of their high energy density compared to other lithium chemistries. In our demand estimate so far, we have not considered the use of cobalt batteries in aerospace. Therefore, there is no direct downside risk in our outlook. If investigations show that there are safety risks, we understand that the automotive industry may also be affected. In that case, it will be our long-run forecast that will be impacted. This is because electric vehicles have not seen yet the strong growth anticipated in the past, and also battery chemistries using cobalt have not been extensively used so far. Nevertheless, we project that lithium cobalt oxide batteries will be used in the automotive industry, but this is going to take place in the long run. In the field of consumer electronics, we believe that these incidents will not have any significant impact, as the market has already factored in earlier battery incidents in portable electronic devices. This is the market balance. The fact that the market is currently in surplus is reflected through price dynamics. Bringing our supply and demand forecast together, we project that the market will remain oversupplied until 2016. Our view is that towards the end of the forecast period, the market is going to be tight, and this is based on a conservative outlook for possible projects coming on stream. The situation could change quite dramatically in the long run, especially if demand for cobalt continues to grow at current rates, which is our base case scenario. Our price forecast goes out to 2017, and what we forecast is the nominal price of low and high-grade cobalt. Low-grade prices averaged $13.4 per pound last year. In the first 2 months of 2013, low-grade cobalt averaged $11.4 per pound, and we expect that in full year 2013, prices will move up to $12.5 per pound on average. It is anticipated that the prices may increase in the remainder of the year, driven by seasonality and restocking, rather than a rally fueled by any improvement in the fundamentals. Our view is that prices will continue to hover within a narrow range, and this is an indication that the market is oversupplied. CRU projects that prices will remain under pressure in 2014 as production will continue to be strong. We believe that the situation in the market will change from 2015 onwards as oversupply is expected to fall. Turning back to historical prices, we are comparing monthly free market prices against those of the LME. Both price series converge to each other and behave as if they fluctuate around the same trend. It is evident that both prices have lately been less volatile, and CRU attributes that to oversupply. With the LME contract launched in early 2010, we now have 3 years of history. Therefore, these comparisons begin to have a strong basis. In this slide, the chart on the left shows the development of the LME Cobalt contract. To comment on the magnitude of this, we compare the Cobalt contract against other LME contracts in 2012. As you see in the table on the right, we have calculated a ratio which is obtained when we divide trade volume by physical consumption, as estimated by CRU. In the established base metal contracts, the ratio is a high multiple of consumption. This means that in the case of nickel, for example, futures turnover was 40 times higher than annual consumption. In cobalt, it was well under 1. Therefore, a higher turnover is required for the cobalt contract to be considered as a liquid one. We will now conclude the cobalt section. From a price perspective, oversupply has been putting downward pressure. Low prices led to industry restructuring, and we believe that this trend will continue. In mine production, copper operations have gained importance. In raw materials, Chinese imports contracted last year, leading to a reduction in stocks, but this trend is not expected to continue into this year. We retain an optimistic demand outlook, but we are highlighting the fact that one end-use sector only is increasingly responsible for demand growth. Our price outlook is weak due to poor fundamentals in the near to medium term. Finally, the LME Cobalt contract has seen gradual development. This is the end of the presentation. I have provided my contact details, so if you would like to ask anything about Cobalt, please feel free to contact me. I have also included the contact details of my colleague who is responsible for our nickel research and kindly helped me put together the nickel section of the paper. Thank you very much for your attention.
Thank you. Do we have any questions for Panos? We have one here.
Gerd Oehm from NiCoMo. The oversupply you showed in regarding nickel in your slides is only slightly half of what INSG is reporting. How can you explain that huge difference?
This is based on quarterly numbers, so we have aggregated annual numbers here in order to provide a broader long-term picture.
No, INSG just released a few weeks ago the annual 2012 numbers.
This comes from our nickel market outlook, so I can refer you to my colleague who will be more than happy to provide with comments on that.
Okay.
So let's speak after the paper. Yep.
Any further questions, John?
Thanks. Could I just confirm some figures that you said, Panos? You said the nickel price will average 17,000 in 2030. Is that right? Where more or less where it is at the moment?
The nickel price forecast for 2013 will be roughly at the same level like last year, yes.
Yes, and you mentioned some closures in Venezuela, Cuba, and a third one, which I didn't get.
I refer to the NiCoMo plant in Cuba,
Yeah.
the Southern Urals nickel plant in Russia, and the Loma de nickel plant in Venezuela.
Right.
And I also refer to the Onca Puma facility, which is anticipated to contribute, but to a limited degree.
Okay, thanks.